Hello, good morning and good afternoon to all of you joining us today. Let me take the honor to first thank you all. And we're just going to begin our masterclass in a short while. As we begin, I would like to request you all to please keep your phones muted during the session. And this masterclass is just for about 30 minutes, as you all know. But we still encourage any questions that you might have during the session. So if you have any questions, please post them to the host on the WebEx chat, and we will respond to those questions at the end of the masterclass in the order received. And if there are any other additional unanswered questions due to time constraints, we will reach out to you and respond over to them separately. We are also recording this session and will be available for all the registrants on our website, and we'll be sharing the link with you all. Today we are having our 7th masterclass, Digital B2B Credit Best Practices. And our masterclass speaker, John Salek, an order-to-cash process expert with 3 decades of proven performance across a broad range of industries and over 250 clients. John continues to share his knowledge, experience, and insights with us. Thank you very much, John, for doing that for us. And let me now hand it over to John. John, can you please begin the masterclass for today?
It's a pleasure, Audrey, and thank you very much. It's a pleasure to be here today, and we've got a good topic again, as we do every master class, talking about best practices credit management, and not only process best practices, but also digital capabilities enhance those best practices. So, we'll do a quick introduction, talk a little bit about credit management, how it's changed, and then let's go back to basics and look at the fundamental best practices in credit risk management, more from a process standpoint. And then let's talk about how digital automation has enabled this process tremendously in the last couple of years. Give you a real life case study, recap the benefits and conclusion, and then answer any questions you may have. Just to get us started here, probably items you've heard many times now in the past 8 or 9 months. But remember, the level of credit risk in the economy is much, much higher than it was a year ago, and probably not since the Great Depression here in the United States in the 1930s. In addition, it's reduced revenue levels of many companies, which is a threat to their survival. So as a supplier, you need to really up your credit risk management game, and in terms of speed, effectiveness, and we're going to talk about how that can be done. In particular, what are the more urgent credit challenges that have been established in the pandemic economy? Well, first of all, for most of you, you're going to be facing more bankruptcies than you did in the past. You're going to have to sell on credit, uncreditworthy customers, much more. Now, think about that statement. That's counter to everything you've been trained and practiced in your credit career. Sell on credit to uncreditworthy customers. So, not a desired state, but certainly a very necessary one for many, many companies. And to make it worse, the credit ratings that you compiled, paid for, from earlier this year are out of date, and in many cases, extremely out of date. So the challenge is, how are you going to generate adequate revenue while avoiding terrible cash shortages and potentially catastrophic bad debt? That's the challenge. And how has it changed? We know the stakes have gotten higher. We know the risks have gotten higher, but how else has it changed? Well, for many of you, you and your team are working from home. And clearly your team needs that full functional capability. And management needs visibility, not only to results at which too late, but also the operation volumes, the operational quality, that capability. As I mentioned earlier, the environment is one of elevated credit risk, but it's also one of a much higher workload for credit departments. And why is that? Well, as we said earlier, with your credit data from earlier this year being out of date, you need to update your credit limits, and you need to update virtually all of them. And rather than updating them annually, as you may have done in the past, for a lot of these customers, you're going to have to update them quarterly or maybe every 6 months. So that's volume, and it's adding work, and a lot. Beware customers. It may seem like a strange statement, particularly if your revenue's down. We welcome new customers. Well, yes, but the right ones, the ones who are going to be able to pay you. And a lot of new customers that come to you, probably coming to you because their existing suppliers have shut them off for non-payment or rejected their shipments to them. So you got to be real careful there. You don't want to offer credit problems, but on the other hand, you desperately need that revenue. So stakes are pretty high. And then order hold volume, and the resulting discussions and negotiations with customers have and will increase tremendously. In fact, with a lot of your customers, you'll be proceeding on a order by order basis. You know, we got your order, not processing yet until you pay us some money. So they pay, you release the order, and then next week, rinse and repeat is you'll go through the same thing. Now, all that takes time. Remember, the order has to be, you have to, somebody investigate what the situation is, somebody reach out to the customer. Clearly, you don't always get through on the first attempt. So it can chew up a lot of time. So when we say the workloads increased from these three factors, we're estimating anywhere from a doubling to a tripling or more of the workload in your credit department. And of course, any requests for additional staff are not going to be well received. And then the other thing that's going on with restriction in travel, a lot less face-to-face contact, what we're seeing out there in the B2B arena, not consumers, is accelerated shift in e-commerce. More and more your customers will be placing more and more of their orders via your e-commerce capabilities. And their expectations are going to be fast and easy, right? I mean, just like Amazon. So if it's taking you 4 or 5 days to make a decision on a credit application for a new customer, that's going to hurt the customer experience and may turn them off, and you may lose them as a customer and may constrict repeat orders. So these are some big changes. These are some big challenges that have to be met. So not only is the credit environment much worse, but the infrastructure, the environment for you to get that work done has gotten much difficult as well. It's the workloads increased. So how do you cope? Well, at a high level, two things. Think back to your fundamental credit management best practices. We're going to review them quickly here. Make sure they're in place and make sure they're being executed well. You know, are they really being executed well? That will go a long way to protecting you. And then the second way to cope is automate, digitize the manual and semi-manual operations. Because remember, your workload's gone up, the stakes have increased, let's eliminate the manual and semi-manual work, and let's focus on the more automated thought processes required to manage risk in this economy. All right, let's talk about the fundamental credit best practices. And these are really base principles that followed pretty much guarantee you have a good, strong credit risk management function. This is a busy slide. We start with the trade credit strategy. What is that? Oh, essentially, that answers that question posed up top. How will you use trade credit to maximize profit and cash flow? And the way I always explain that is, let's look at the two extremes. One extreme is grant credit to anybody and everybody, maximize revenue, hope you get paid most of the time, reasonably soon, and just try to manage and hope that the revenue increase and the revenue level is enough to deliver a profit and adequate cash despite number of customers not paying timely or not paying at all. Usually this can be used if you have a very high gross margin business, because then the bad debt doesn't hurt you as much. The other extreme is lockdown. We're only going to sell to the really strong financial customers, the bulletproof credits, who pay most of the time without even being on time or without being followed up on. So our cash flow will be strong. Our bad debt will be zero. And we don't need a lot of people. We don't even have to contact these folks. They're self-payers. Well, that's great. Really restricts your sales, though. Typically, I've seen this approach with the lower gross margin. You know, we had a distributor client that operated on a 2% gross margin. So what that means is if they had a $1 million bad debt loss, they had to sell $50 million worth of product just to compensate for that loss. So that's where bad debt has a really serious impact. Now, I've never seen a real company embrace either these extreme strategies. You know, some have come close, but never to the extreme. And what's the common strategy, though, is somewhere in between, right? And which one is right for your company depends on a lot of things. You know, your go-to-market strategy, all those types of things. But the important thing about a trade credit strategy is to make sure it's articulated, make sure senior management agrees with it, make sure it's communicated. And everybody who's involved knows kind of the philosophical underpinning of the way you're going to run your credit and collections operation. And then once that strategy is articulated, then a credit policy is developed, a written credit policy that defines as best as possible the company's risk appetite and defines the processes to control that risk. This is really a foundation of credit risk management. I'd be surprised if anyone said their company doesn't have a credit policy. If you don't, you should get one and document it and ensure senior management agrees with it. All right, so those are the kind of the overviews, the foundations. Then we start getting into some process and practice. And the first process is credit vetting, which is a good English word, synonymous with investigation. And that is the research that is done to set a credit limit. Credit limit, well, it quantifies the tolerable amount of risk exposure for an individual customer. So, you know, it doesn't do any good to say, oh, we checked out that company. They don't look too strong. I wouldn't give them much of a credit limit. Okay, well, how much is much of a credit limit or not much of a credit limit? Need to put a number on it, because then that's you manage to that number. And that number is the embodiment of the risk tolerance for that individual customer. So it's a very, very important element here. Well, it's financial analysis and assessment of a customer's financial strength taken from many sources: financial statements, the credit bureaus, references, a host of inputs, and then those factors are weighted, combined into a credit score, which then defines not the credit limit itself, at least the range of the credit limit. certain profit margin on sales made to that customer affect the credit limit, as does their purchase requirements. If they're going to buy $50,000 a month, you don't have to give them a $1 million credit limit. So it's scaled. And, the credit vetting is very important when you start business with a new customer. That's the initial vetting. But then these updates that I said you need to do now quarterly or every 6 months for a lot of your customers, go through the same process. The big advantage there is you have some experience with this customer, some payment history. Although, quite honestly, that payment history may not be a predictor of future performance. But here again, the credit limit, credit vetting, and the credit limit, critical elements of practice credit risk management. All right, so we set a credit limit. Now the next major task is to control the exposure to loss. And how do you do that? Well, two major ways. One is effective collections. And you may laugh when you hear that, but people kind of forget about it. You want to reduce your exposure to bad debt? Well, reduce your AR. And the way to do that is effective collections. You're paid before the customer pays other suppliers. And what's nice is that not only reduces the exposure, but it also enables you to service that account better. For example, let's say you set a $50,000 credit limit, and they normally buy $30,000 a month. They get a little in their payments, and they owe $40,000. It's not critical. It's a high-risk scenario. So if they place in another moderate order, you can accommodate that. Still have room under that credit limit, and still have the aggregate exposure within the limit that you calculate. Collections often overlooked as part of credit risk management, but a very, very important part. And then the second part is order holds. I talked a little bit about that before. The customer is over their credit limit, or they've violated some sort of delinquency limit, so the order is held until they correct that situation. It involves, back and forth discussions and negotiations. But the important part is to hold that order before it gets shipped and increases your exposure. So those are the two major factors, mechanisms for controlling the exposure. And then the last part of these fundamental best practice processes is credit insurance. Not sure you call that a process, but anyway, it's a big factor. There's a lot of big credit insurance underwriters out there, and there's a lot of companies that buy it. And it does what it says. It protects you from those catastrophic bad debt losses. Plus, you benefit from the credit insurer's extensive knowledge on managing risk in different geographic markets. It's nice to have. The disadvantages, a lot of times they don't cover the high-risk customers you want. They'll cover Apple and Facebook, but startup company, small, undercapitalized company, they'll exclude. And then they'll say, but we have to include Apple and Facebook in the pool so we get a good read, and we're consistent with the principles of the theory of insurance, that sort of thing. But and it can cost a lot. So you're getting insurance for customers you don't want it on, and you're not able to get it for the customers you need it on. So look carefully with it. But again, a lot of companies use it. I mean, it's pretty widespread, so it's helping a lot of people, and a lot of people think it's a good deal. So don't let me get too negative here, but it's elements. So when we talked about the fundamentals, we talked about the credit strategy. We talked about the credit policy. We talked about credit vetting. We talked about controlling it through effective collections and the order hold. And then the last is kind of the measure last resort is the credit insurance. So those are all kind of time-honored practices for controlling credit risk. Oh, that's great. But as we talked through those, you could probably appreciate, and you probably know, there's a lot of steps, a lot of actions, a lot of operations required to do all those, to execute those fundamentals. And if they're primarily manual or semi-manual, that's a lot of work, particularly the increased work we talked about earlier. And it also can be slow. And what we believe very strongly is that digitalization and automation of a lot of these credit risk management processes will deliver not only productivity, but the speed and efficiency and accuracy that you need to cope with this economy. And what are some of those capabilities? Well, it's a lot, and it's a lot better than it was years ago. Credit app, online credit app for customers. They complete it and submit it online, and you can customize it the way you want it. That saves a lot of work. Customer does all the work. Automatic real-time report of the credit bureau information, Dun & Bradstreet, Experian, whomever. Bring it in, payment history if that's applicable. Bring that all in. Do your automated credit scoring, and go a step further and say a credit score between value A and value B results in a credit limit of $100,000. All be automated. Now, you probably want a human being to check some of these, particularly the larger ones, but up until then, it can be automated. Huge time saving, huge productivity improvement. And then, of course, the higher credit limits need more than approval. And this can all be routed through a full-featured workflow that conforms to your delegation of authority policies. And this credit limit update that we said used to be annually and now is going to be more frequently, well, that can be largely automated as well. So what 10 minutes ago looked like a huge increase in workload, with these tools can be executed quickly and with little manual input. We estimate, if you look at all the manual, semi-manual work, the transaction work and credit risk management, we estimate that as much as 70 to 80% can be automated. And really, given the challenges we explored the outset here, it's, from my way of thinking, it's the only way to really meet the requirements of the increased risk, increased workloads, the need for speed to respond. Some of the others, some of the capabilities, again, digitized, automated, number of them enhanced with artificial intelligence, particularly as you start getting into automatically setting credit limits. That's where AI comes in. But what are some of the others? Well, the automatic order hold, integrated with collections. You want that to be automatic. And you want it to be, in effect, 100% of the time when it should be. What else? Credit scorecards. How's the credit risk management function operating? Well, let's have a scorecard. And again, let's track on the level of activities, the backlogs, the volume and age of backlogs, status of credit apps. Along with these enhanced capabilities come better analytics and focus on the risk. And let's make the overall risk of your whole portfolio. My guess is it's increasing as time goes on, and you need to be aware of that. And lastly, we talked about one of the key overlooked ways to control exposure to credit risk was effective collections. Well, if you look at most credit departments, they don't have enough collectors to contact all the customers. Well, a lot of that contact can be automated at as much as 80%. And this is a huge benefit when you're trying to get good coverage of your portfolio, plus allow enough time for your team to work on the problem accounts. In addition, the tools prioritize the collectors' work, give them a task list when they log on in the morning, workbench that has all the tools and capabilities they need, document storage and retrieval they can send to customers, and then again for management, a dashboard to look at activity levels as well as results. And that's key, activity levels. And these new digital automation capabilities really work in the work from home environment, which was another of our big challenges. Here's a quick case study. Customer building materials deal. And if you're familiar with that industry, most of the customers rely very heavily on vendor financing. They're not particularly well capitalized. So our client obviously wanted to provide that financing, but it's a credit risk. And their semi-manual system of getting credit out, reviewing that, and doing the research, et cetera, just wasn't keeping up. So they implemented Emagia's digital credit automation solution with the digital credit app, the digital signatures, the automated reference checks, retrieval of information from Experian, who is their credit bureau. They had their own analytical tool built on NetSuite, and it just took all that data and produced a credit limit. Interestingly, there's also an automated resale certificate verification process. This is for sales and use tax. And this is also very important because if you don't manage sales and use tax well, you can end up with some sizable penalties from the various states. And that's kind of a pain in the neck process. So to the degree you can automate it, you're better off. So for this particular customer, we estimate that about 80% of the credit vetting process was automated. So think what that does for speed, workload, productivity, as well as accuracy. And they're they're processing these credit apps on a timely basis now and keeping up with the demand. What are the benefits? We've been talking about them all along, right? Productivity, ultimately enable you to maximize the revenue while controlling credit risk, do better with your e-commerce areas, and all those things add up to a better customer experience, better assessment and control of risk, higher revenue, profit. So to wrap up quickly here, we saw what the COVID-19 economy has done in terms of risk, workload, demand for e-commerce, and in addition to refreshing those time-honored credit fundamental best practices, really need innovation and digitization capabilities to keep up and will keep up to survive and excel. Okay.
Thanks a lot, John. Let's open up for questions. And as we have a couple of minutes, let me just go ahead with the first question that we have in here. Can online access to credit bureau data be established with all credit bureaus?
Yes, absolutely. I mean, it's certainly in the credit bureau's interest to accommodate this capability as well. And it's a common occurrence now. Doesn't diminish its importance. It's just well accepted now.
Right. Thanks, John. And just for the sake of some of the participants who joined in a little bit, I just want to let them know that we are now taking some questions. If you do have any questions, post them on the chat window over here. So let me bring up our second question in here. How flexible is the automated credit decision making?
Extremely flexible and customize it to your preferences. So if you look at a credit app, there's maybe 10 or 12 elements of data. Some credit managers value those very highly, and the rest less so. Some choose to streamline the credit app and instead of having 10 or 12 data elements, cut it down to 6. whatever your preference, you can do that. You can design that in. So it works exactly as you feel it should.
Right, yeah. Let's take one last question in here. Can the automatic order block be triggered by either a past due or over credit limit condition?
Yes, it can. And that's actually a best practice. I always advocate that either or of those conditions trigger an order block. The other caveat here is you don't want a customer being $1 over the credit limit to trigger an order hold. So you can build in tolerances as well. Maybe it's 5%, something like that, only when they're 5% over their limit. But again, very flexible and very, very effective, particularly in this pandemic economy.
Thank you very much, John. I think we're just on top of the hour timeline. Just want to invite, first thank all the attendees over here for spending their 30 minutes with us. If you do have any questions, feel free to write to us. If you're looking at the slide in here, our email address where you could post your questions is info@emagia.com, info@emagia.com. And we're going to have our next masterclass on 17th of December, which is again a Thursday at 10 a.m. Pacific time. The topic of our next masterclass, which is going to be eighth in our series, is five best practice AR metrics you should track. So that's going to be quite interesting because that's going to be talking about all the metrics that are very, very important in terms of having the best practice AR metric established. So we look forward to seeing you out there again. So please book your seats today, and we look forward for our next session on 17th of December. Thank you very much, John.
Thank you. Welcome. And you're right, actually. That's going to be a good master class 2 weeks. This topic of
Oh, yeah.
metrics is one I have very definite opinions on, and some of that might a new way of thinking for some. So
Oh,
would urge you
yeah.
to attend and listen and enjoy.
Yeah. Thanks a lot, John. Thank you.